Good morning, everyone. Welcome to Phillip Securities Research Morning Call. For today, we have quite a few stock counter updates from Yoma, Prime US REIT, Dasin Retail Trust, Singapore Airlines, Koufu Group, Thai Beverage, Q&M Dental, Geo Energy, and Sri Trang Gloves, before we wrap up with our usual SG Weekly. So without further ado, let me now pass on the time to Jie for Yoma.
Thanks, Vivian. I'll be going through Yoma's first half results. So starting with the product list, next slide please. First half revenue and net profit met expectations at 54% of our forecast, 54% of our FY21 forecast. Top line was brought up by real estate recognition. Development revenue increased by 28% due to sales at the Peninsula Residence, Star Villas, and Palma Estate. Additionally, Yoma cut OPEX and deferred the bulk of its CAPEX to conserve cash. Staff costs were slashed by more than 60%. The company also reduced inventory and monetized existing PPE stock. As such, admin expenses declined close to 20% on a year-on-year basis. Interest expenses fell by 14.2% due to lower interest rates. But as more stringent financial management has been implemented since the start of the coup, we are expecting cost efficiency gains to be recognized in the coming months. Some may have questions regarding Yoma's solvency, so I'll just provide as much color as possible. So for this half year, gross profit is able to cover interest expense. Yoma is still operating cash flow positive. Ayala is still not pulling out the deal to invest 46 million in Yoma at 45 cents per share. This amount is already pre-funded to Yoma in the form of debt. So as you can tell, Ayala is still committed to the deal. In terms of short-term debt due in 1 year or less, is about 100 million. Right now, Yoma is in active discussions with lenders to restructure and refinance this amount. Cash level stands at 49 million, which includes 13 million worth of reserves or cash collateralized for interest payments that they didn't utilize. For interest payments that they did not utilize before. So this can help Yoma buffer through this period of time. So now for the negatives, F&B and motors were the hardest hit by COVID-19 and the coup. Temporary store closures were frequent and operating hours shortened against the backdrop of weaker consumer sentiment. On the motor side of the business, heavy equipment was affected by disruptions to higher purchase financing from local banks and also delays in port clearances. The automotive business was hit by closures of vehicle registration offices and dealer showrooms. As a result, first half F&B revenue fell by almost 50% and motor revenue fell by 27%. Next, please. Okay, so in terms of outlook, we believe the coming half will be weaker than the first half that was just passed. We expect second half top line to be partially supported by 19 million worth of revenue for recognition from units sold at Star City and Palma Estate, as construction is still progressing for those two projects. The construction for Yoma Central, which we expected to complete by 3Q22, has been suspended in the near term. The restaurant business will be affected by lower consumer spending throughout the country, and Yoma is looking to close temporarily or permanently up to a third of its restaurants if it can no longer be operated profitably. For Wave Money, the resumption of internet access is expected to help the transaction volumes and monthly active users recover. However, Wave Money's proposed partnership with the Ant Group and Yoma's proposed acquisition of a controlling interest in Wave Money from the Telenor Group has been halted. There are no obligations to complete either or both transactions. So following this, Yoma will likely explore other opportunities. As consumer sentiment remains weak and higher purchase financing by local banks is less readily available, sales of heavy equipment are expected to be slower. This is because most of the products are larger ticket items and they require higher purchase financing. Automotive sales may be less affected. However, we do believe that the credit tightening may persist in the near term, so this will affect the sales of Yoma Motors. So the last portion will be our call. We maintain neutral on the counter with a lower target price of 14.7 cents from 15.6 cents previously. We cut our FY21 and FY22 forecast profits by 3% and 25% after factoring in lower development sales and motor sales as well. Also, we factored in the suspension of Yoma Central's construction, which was originally planned to contribute to 4Q22's top line. We also factored in the temporary closure of restaurants. for our target price, we actually lowered FY21 book value per share by 8% to 24.4 cents from 25.7 cents to reflect the suspension of Yoma Central and the Myanmar Kyat, from the Myanmar currency depreciation. This is mainly coming from the declines in development and investment properties. Out of 338 million worth of development properties in the first half balance sheet, 274 million is actually attributable to the development of Yoma Central. So a big bulk of the current development properties is attributable to Yoma Central. Yoma Central is actually booked at cost. So as construction progress, we are supposed to see Yoma Central's portion increase. However, since this portion is suspended, it's likely that we will see the growth in DP placed on hold. And also, as the Myanmar Kyat USD hit a record high of 1629 on 17 March and has since lost 20% of its value since the start of the coup, we actually lowered development properties by 11.7% and investment properties by 6.5%. Therefore, in addition to that, we also, as in our target price is still back at 0.45 times price to book. So all in all, we are lowering our target price to 14.7 cents and we maintain a neutral call. This is all for Yoma. I'll move on to Prime's update. Next, please. Okay, January for them, it was a resilient quarter. Results were largely in line with expectations. So starting with the positives, first quarter's MPI and DPU met 23% of our FY21E estimates. This is due to high rental collection rates at 99% and minimal concessions granted to tenants. Year-on-year, gross revenue and MPI remain steady. Property expenses increased by 11.7% due to a full quarter share of Park Tower's expenses, which was acquired back then on 24th March 2020. The second positive for them is in terms of their leasing activity and minimal expiries. In 1Q21, Prime signed 58,000 square feet of leases at positive rental reversions of 9.5%. More than 80% of it were renewals or for expansion by existing tenants. The minimal expiries coming up help to provide greater visibility to Prime's income stream for the next 2 years. The leases expiring in FY21 are well spread across its properties with no contribution above 1.4% of cash rental income. Negatives-wise, several properties dipped quarter-on-quarter in terms of occupancy. The more notable declines were at 222 Main in Salt Lake City and Promenade 1 and 2 in San Antonio. The main reason for the decline was that a few properties actually left the buildings. January's COVID-19 spike actually paused leasing in those markets. As such, portfolio occupancy declined by 0.7% to 91.7%. Still, this is well above Class A office average of 84.3%. Now, in terms of outlook, widespread COVID-19 vaccinations have resulted in a swifter return to offices than originally expected. According to JLL Global Real Estate Perspective Survey in May 2021, most companies across the trade sectors that Prime is exposed to are expecting at least 80% of their workforce to return gradually to office from second half of 2021. Goldman Sachs, which is Prime's second largest tenant, has actually pushed for employees to return to office by 14 July. Additionally, Prime actually detects a pickup in leasing in Denver and Atlanta. Therefore, all in all, we are expecting portfolio occupancy to improve closer towards stabilized levels of 94 to 95% by first half 22. The last portion, Prime is also on the lookout for acquisition opportunities. As of late, there has been more interesting deals in the acquisition market, particularly for Class A office assets in urban centers. So with low gearing of 33.8% and a debt headroom of 290 million to a 45% gearing, Prime should be in a position to take advantage of these opportunities. We are downgrading to accumulate from a buy rating for Prime at a target price of 94 cents. This is due to a share price uplift in recent months. This is all for Prime. I'll pass my time on to Ned for Dasin.
Thank you, Tehui, and good morning, everyone. So moving on to Dasin's first quarter business update. On the positive side, first quarter 2021 revenue was in line, forming 24.7% of our FY21 estimates. So the first quarter revenue grew by 87.4% year-on-year, and 51 percentage points of this growth stemmed from recovery in variable rents as well as an absence of rental rebates provided in the quarter. So just as to provide some color, the first quarter of 2020 was the quarter in which the China retail market was the most affected. So that actually resulted in quite a lot of rental rebates provided in that quarter, corresponding to the current first quarter 2021, where there was actually no rental rebates that were offered. So another part, the remaining 36.4 percentage points of this revenue growth was contributed by Shunde Metro Mall as well as Taipei Metro Mall, which were acquired in July 2020. Overall, we saw that the first quarter 2021 same-store revenue growth was at 94% of the pre-pandemic levels. Now moving to the negatives. Occupancy dipped quarter on quarter from 96.4% to 96.1%, and this was attributed to a 1.7 percentage point decline in Shunde Mall, as well as a 1% drop in Ocean Metro Mall. Yeah. Okay. So one of the low occupancy at Shunde was due to 800 square meter non-renewal from a tenant in the entertainment trade. I'm sorry, next. Yeah, okay. The lower leasing volume in first quarter 21 was due to the back-end loaded FY21 expiries. And in terms of leasing demand, we saw that demand from F&B tenants has normalized. However, demand from fashion and services remains weak. Rental reversions, although not disclosed, we estimate them to be in a negative single-digit reversion range, and this is in line with market trends. Moving on to the outlook. A significant 31.1% of leases by GRI is up for renewal in FY21. Half of these leases are attributed to two tenants. A furniture tenant at Ocean Metro Mall has already indicated their interest to renew, as well as, if you recall, in November of last year, one departmental store located at Ocean Metro Mall, which is Superior City departmental store. This departmental store actually accounts for about 15% of the NLA in Ocean Metro Mall. They actually pre-terminated their lease, and this space was subsequently signed on a 1-year lease term. So that means this lease term will end in November 2021. So that actually accounts for these two tenants actually account for the bulk of the 31% expiries in FY21. Yeah. Okay. In terms earlier in the month, Dasin actually announced a strategic partnership with ARA Asset Management. So what happened here was ARA Asset Management actually entered into a non-binding memorandum of understanding with Mr. Trang, the chairman and controlling shareholder of Dasin's trustee manager. So ARA Asset Management will be acquiring a 50% stake in the trustee manager from Mr. Trang, as well as 5% of the total units issued, which is actually from Aqua Wealth. So Aqua Wealth Holding Limited is actually the major shareholder of Dasin. So there will be no new units issued. It's just a transfer of units. Yeah. So in terms of the benefits of this strategic partnership, the management believes that there will be synergies from the complementary resources and capabilities from the operations between these two entities that are located within the Greater Bay Area. So during our analyst call, there were also some questions regarding whether or not Dasin will be able to acquire any assets from ARA Asset Management. So in response to these questions, the management shared that Dasin still has a ROFR pipeline of 15 assets from its sponsor, and because of the higher return expectation that investors have, Dasin will need to rely on the sponsor support to make accretive acquisitions. So just to provide some background, since listing, Dasin has acquired 4 malls from its sponsor at an average 25% discount to valuations. So this discount to valuations has actually allowed Dasin to acquire make their acquisitions accretive. And so in the near term, the trust will focus on acquisitions from its sponsor first before exploring any assets from ARA. Next. We maintain our accumulate call on Dasin with an unchanged target price of 82 cents. We did not move our estimates this quarter, and Dasin is tracking our recovery expectations. So the current price actually implies a dividend yield of 6.7% for FY21. So that's all for Dasin. I'll now pass the time on to Timothy for SIA.
Yep, thanks, Nat. Today I'll be going through the rights mandatory convertible bonds that SIA announced along with their results last week. So the mandatory convertible bonds will raise 6.2 billion to aid SIA with its finances. So if you're an existing shareholder of SIA, for every 100 shares that you own of SIA shares, you get 209 rights mandatory convertible bonds. And this whole deal will be irrevocably undertook by Temasek, meaning that any of the unsubscribed MCBs will be subscribed by Temasek. So just an overall look at the deal. So for the table at the top left-hand corner, so you see for every $1,000 that you invest in these mandatory convertible bonds, so you invest $1,000. This $1,000 will become $1,698 in 9 years' time. And how SIA will pay you this is by giving you SIA shares at a price of $4.84 in 9 years' time. So this translates to 350 SIA shares at maturity. So if you invest $1,000 in these MCBs, you get 350 SIA shares at maturity. And that translates to a cost price of $2.85 today and an annual yield of 6% if you hold until maturity. So some of the structures of the MCB, the bonds itself, the maturity date is on the 8th of June, 2020. So that's a 9-year tenor. And it's zero coupon, so they won't pay you any coupon until that time. The issue price is $1 per MCB, and the final accreted principal amount is $1.69, $1.69797. Yeah, so that translates to a 6% yield. SIA will also have an optional redemption clause inside, so they can actually redeem it from you earlier. So if they choose to redeem it from year 1 to 4, the yield is only 4%. 5 to 7 is 5%, and 8 to 9 years is 6%. And these MCBs will also be tradable on the market, so you can sell it off if you wish to. The timeline, 27th of May will be the X-rights for the SIA shares, and we'll see the theoretical X-rights price later. The first day of trading for the rights is the 2nd of June, and the last day of trading of the rights is 10th of June. And the last day for you to accept and make payment for the rights is on the 16th of June. Then commencement of trading of the MCBs is 25th of June. So in the summary of the deal, the table on the left, the second table, so the MCBs won't be diluting the share price much. Okay? And the reason is because the shares will only be given to the bondholders in 9 years' time. So the dilutive effect will not be coming in at this point in time. So the theoretical X-rights price is $4.79 compared to the price last Friday, which is $4.77. So some of the positives, this rights MCB is not counted as debt and also not counted as equity. So what this means is that this 6.2 billion is coming in as if it's cash, and this will strengthen SIA's balance sheet debt to equity ratio from 88% down to 64%. And also there'll be no share price dilution until maturity or early redemption. So the theoretical X-rights price is about the same as the current share price. For the negatives, from a fixed income investor's perspective, it doesn't look that attractive. Reason being, the 6% yield that they calculate the yield to be is not promised. So if the share price is actually lower than $4.84 in 9 years' time at maturity, then the yield will be lesser than 6%, simply because you can't sell the share that you receive at least $4.84 in the market. So the yield will be lower if the share price is lower than that price. And the second thing is that it's zero coupon, so you receive no yield until that 9 years. But from an equity investor's perspective, you can look at it as you're buying SIA shares at the moment for $2.85. And if the share price is higher than $2.85 in 9 years' time, then you do make a profit. Yeah, so that's all for the SIA rights MCBs. Pass my time on to Terence.
Thanks, Timothy. So we cover Koufu, who provided an operational update on their first 4 months performance. Also do take note that there was no financial results that were provided in this operational update. It's just really an update as Singapore moves towards phase 3. So there's some background. Y'all may already be aware, following a sharp spike in the unlinked community COVID-19 cases, Singapore moved from phase 3 heightened alert to phase 2 heightened alert currently. In a bid to curb the chain of transmissions, further restrictions have been imposed. So some of these, we just summarize some of these. This include prohibition of dining in at all food outlets, a capping of social gatherings and activities to 2 persons, and a reduced capacity for malls and work from home as a default mode of operations. So this has an impact on the overall operations on the whole entire Koufu Group. So some of the positives from this is that the job support scheme grants, the JSS grants, will be enhanced to 50% from 10% up till June. So it's just going to be 1 month because this current restrictions is for a 1 month period. So the increased grants is for a 1 month period. For 40% more. And another positive is that even though the situation in Singapore is now very we are in a tricky situation now in Singapore, but the situation in Macau has improved. So they've opened up their borders since March and April of this year. And in the latest Labor Day holidays, and what they've noticed is that they've seen a marginal improvement in the footfalls in Macau. So Macau is actually improving for them. Though we hasten to add, it's also not back at the pre-pandemic levels, but they've seen some improvement. The negatives from this, of course, is the footfalls have dropped after Singapore's move into phase 2. What Koufu has done also is some of the F&B retail business outlets, they've just closed it, especially those at the downtown areas, the office areas, and also at the Singapore Management University has also been closed. The commencement of the integrated facility, which is the new big central kitchen for them, has also been delayed again to the third quarter of 2021. This is the third delay already for Koufu. So they now, because the delay is because of some delay in the construction of the integrated facility, and they cannot get some material. So now there's some delay. So what we have to do then, we have to reduce and tone back some of the cost savings that they will actually have gotten if they moved into this integrated facility. So our recommendation, in light of this slower than expected recovery in consumption, we lowered our revenue estimates for FY21 and FY22 by 1.8% and 1.9% respectively. So this 1.8 and 1.9% for FY21 and FY22 really accounts for this drop for in 1 month restriction in the dining in. So you can still take away and people can still order delivery at these food outlets, which is why the impact is mitigated in that sense. But the lower footfall still has an impact on them. So profits consequently are reduced by 6.1%, 8% from the negative operating leverage and the delay in the completion of its integrated facility. So we then downgrade our accumulate rating to neutral with a lower target price of 64 cents, previously 68 cents, also still based on 18.5 times FY21 earnings. So that's all from me for Koufu. I'll now pass on the time to Paul.
Okay, thanks, Terence. We'll move on to K&M's first quarter results. The title of the report was profits more than tripled. I guess that's because because the profits actually then tripled. Next slide. Okay, so in terms of the positives for us was the revenue. When we're looking at the revenue for us, obviously there will be the COVID-19 PCR test revenue included. But so for us, important is also the core dental revenue. So the core dental revenue jumped almost 40% to 39 million. So obviously the question is, why is so many people going to the dentist? Okay, so anyway, the reason is because, with the borders closed, and I think more time available, obviously, a lot of households are going for more regular and more elective dental procedures. So that's one part. The second part is also on the supply side, because of the lockdown, because of the border closures. So there's more dentists, I guess stuck in Singapore, and that's why their capacity is also higher. So as a result, they get this double benefit of higher demand and also more available dentists to kind of undertake these procedures. Because of the strict requirements, also PCR is, because of the strict MOH requirements that they cannot disclose a lot of items, then that's why the revenue from PCR tests is not separately disclosed. And I think even they mentioned even the SGX cannot ask them to actually mention about the PCR test revenue because it's quite confidential. So although the PCR, so the second bullet point, although PCR test was not disclosed, so one way we are doing it is that we use the minority interest, because because the PCR business is a 51% subsidiary. So obviously the 49 will be at the minority interest, and they don't really have any other major items there. So the minority interest was about 0.6. So you can assume that they made only about 600,000 for this quarter. So it's very small right now. But I think you're going to see the big ramp in the following quarter. So as a result, we kind of doubled our daily test assumptions to 1,002. So in terms of the negative, you can see that as we enter into phase 2 heightened alert lockdowns, dental clinics are still allowed to open. I mean, obviously nobody's going to go. Who's going to go right now when there's everyone's so fearful of leaving their home? So we expect cancellations to happen. The only positive of this is that compared to last year in April, although clinics were open, but they were really very limited. The amount of procedures they could undertake was very limited. They were not allowed to undertake anything they call it aerosol generating procedures. That means if you do scaling, then I don't know, liquids, whatever kind of aerosol kind of goes into the air or something. So that's why almost 90% of procedures could not be done. So last year, all they could do was anyone come in, you can only extract your teeth. So I guess that's only for emergency. But this time around, they can do almost all procedures. It's just that I think we do expect some cancellations. But at the flip side, you will get, of course, more PCR tests, which we will elaborate later. So you can see that the earnings, the PATMI jumped from 1.4 to 6.7. So the results was more or less in line with our forecast, but we're raising it because of a higher PCR test. In terms of the outlook, the amount of PCR tests conducted in the country is not disclosed. There's no data to tell us like how many, so it's hard for us to track regularly. But if you look at media and government statements, in September, the government said they're doing about 27,000 a day. Then there was some commentary that this was going to be like 34,000, and the media mentioned about 73,000. So there's going to be a surge, and the large part of it is usually the RRT, the regular routine test. I think that's the abbreviated service. So what it means is that every 2 weeks, all the foreign workers actually have to do this test. So as a result, you got this base load, and I think obviously with the current conditions, there'll be more and more tests. So in terms of we maintain our buy, so what we did was we raised our target price. Tagging a PE for this stock is not easy because the value PEs have been quite volatile historically, can go up to even 40 times. So what we did initially, we took a 50% discount, but I think when with this kind of momentum in the revenue and earnings, we think we are pushing it to 25 times PE. And of course, we think it's justified because of the higher PCR revenue and the core dental earnings. And also we just added another 3 cents because housing under the associates, if you look at the table, doesn't contribute because it's loss making. So to add that in, so we just put the mark-to-market value of housing into our valuations. And just one final point, so I missed this, is at the revenue line, the box there, you can see that one of the baseline drivers for growth will be the number of clinics. So actually the number of clinics rose about 7%. And as we move into FY 21-22, we think we're looking at about the 20% growth in clinics for FY 21 and 22. I think the only thing is just execution risk. I mean, they also have very aggressive targets. It's just how to execute this, especially with the pandemic situation. Okay. Thanks. Next slide. Okay, for Thai beverage, it's kind of boring set of results. Just that more important for us is that the recovery will be underway in 2021. Next slide. Okay. As a reminder, when we look at Thai beverage, the core revenue, the core profit is spirits. Beer is a lot of noise, but in the end, the main bulk, because spirits contribute almost 90% of profits. So most of the times I just look at spirits business. The rest is more or less noise, I guess. In terms of the positives, what we saw is that the spirits volume was down 3%. Actually, the volume in Thailand was flat. That's why we still call it a positive, because most of it is from Thailand. But what happened was that the reason why volume was flat is that what's happening is a lot of the farmers are returning home from urbans, from the city, where like Bangkok and so forth. So that's why the consumption has kind of held back, because the spirits business is mainly consumed in the rural areas by farmers. But what happened was that Myanmar was problematic, so there was a lot of disruption. As you know, 1st February was the so-called military coup. And what happened, to give you some color, was that the banking system basically shut. So everything had to be transacted in cash. You pay supplier, even the employees had to be paid in cash. I'm not sure how they got the money, but anyway, they have to be paid in cash because you cannot transfer anything. So there was a lot of disruption. You want to sell, there's also cash on delivery and so on. And of course, not to mention logistics is an issue. It was very hard to move around. And of course, not to mention, and also demand obviously also fell from the cliff. So Myanmar was hit quite badly for them. Roughly, Myanmar contributes about 5% of profits in a very rough sense, because I took it from the annual report. The other positive was the aggressive cost cutting. So one thing about Thai Bev is they're really good at cutting costs. When earnings, when rolling down, even at right now when the volumes are more or less flat, they still cut their SG&A by almost 1 billion year on year. So they cut it another 9%. They cut on spending on events, brand building, and everything. The other positive was their interim dividend was up 50% back to their pre-pandemic levels. The negative was, of course, the resurgence of cases in Thailand and lockdowns. So there's been closure of entertainment outlets, and of course, alcohol cannot be consumed. So this will hurt namely the beer and food revenue, because the spirits business is consumed, in farmers and in homes and so forth. And I'm not sure how they can, even if they want to consume restaurants, I'm not sure how they're going to crack down anyway. And also beer will be hit. So that's why beer volumes in Thailand was down about 10%. And food revenue, forget it, because the restaurants are all closed, so the food revenue just dropped like 20%. So in terms of the results, it was more or less within our expectations. First half about 50%, so we did not move our numbers. Okay. For the outlook, there are 3 things why we think they're on track for recovery in FY21. So the first one is beer volumes in Vietnam will rebound, because for those who can remember, in May they had this incident of so-called fake news, which there was some linkage to the ownership of the company and from other countries and so forth. So that caused so that hurt demand for the immediately in May. Then later on, then later on they also got hit by the Decree 100 ban and so forth. So as a result, last year the beer volumes was very bad, so you can expect a rebound this year. But I think the management said it will not go back to pre-pandemic levels. The other thing is, of course, last year again in April, there was a 3-week alcohol ban in Thailand. So obviously this year you don't have this thing, and then so that's why that should also be a rebound. And the third positive thing will be they are still on a major cost cutting, as you can see from their first quarter, they cut by 10%. Our recommendation, we upgraded to a buy mainly because of the share price drop. No change in our target price. And also, how we got target price, we're just taking their 5-year average about 18 times. And as you know, the consumer stocks can trade about 20 plus times. And this stock dropped because of they cancelled the IPO, one of the reasons. So that's how we got the target price. Next slide. Okay, next slide. We will do our usual macro update. For Singapore, really not much news. The only thing was our export numbers. It was a tad slower from the 12% in March, but of course, nothing to we look at year-to-date numbers, because the exports can be volatile because there's a big pharmaceutical. So pharmaceutical can swing 1 month up 30%, 1 month down 30%. So the one that caused the decline was our pharmaceutical. Electronics was still good, about 11%, and year-to-date is about 14%. The next is ready mixed concrete. It's basically a Penyu Hong Yong Asia thing because these are the main suppliers. So the numbers, although March was lower at 4, but I think the positive is that this is the first time they exceeded the 1 million metric ton. Because the last couple of months have been like even 200,000, 400,000. So this time around it crossed. So that's a positive, and the contraction is softening. So year to date is 11, but the most recent month is down 4. So it's improving. I mean, by shrinking less, but obviously that just shows that there's some recovery there. In the US, there were a bit of housing news, so we didn't really bother much about that. But in terms of, we were watching more on the commentary by the Fed officials, after 1-2 weeks ago when they had this big jump in CPI, we just want to watch what is the commentary from Fed officials. So far, those who can vote at least mentioned that the inflation they think will ease in 2022. It's all base effects, supply chain. So nothing much to be concerned about. But in the Fed's April minutes, FOMC meeting minutes, what they mentioned was that in every meeting, if they want to reduce the pace of asset purchases, I'm going to go a bit more detail because they've been buying a lot of bonds and MBS, mortgage-backed securities. So if they actually are going to tell you when they're going to cut back on that, and that might impact the market, is when every Fed meeting they're going to talk about it. So the next June will be interesting to see if they talk about maybe tapering some of their asset purchases, and then you need to see how the market reacts. Later on, I'll just talk about Geo and Sri Trang. So in terms of a tactical view, we think the market, this very short-term view, we think it will be sideways. There's still a lot of debate about inflation, so not sure how bond yields are going to react, and also uncertainty over pandemic, but this is more Singapore and maybe Southeast Asia centric issue. Because what's happening is that the developed countries, we will see later, is reopening quite aggressively. And I guess if there's a way to trade it, will be maybe all, because if there's more travel, maybe land or air in the US and so forth, the demand should pick up. And of course, companies that got exposure to developed countries will be like Escort, even US and European REITs. If you go on to the next section, weeks ahead, we got quite a lot of webinars. I think I counted here, there's like 9 webinars. I guess this week we have Fraser Centrepoint Trust. Then month end in June, I guess it's going to be a popular one, I presume. It's going to be the SPH. So you got any SPH? You can just ask them except for certain questions, obviously. Yeah, next slide. In terms of the pandemic, even though the cases here are quite high, but if you look at outside, globally, the numbers are actually tapering down. So on the month-on-month basis, actually we are dropping like 20% month-on-month. And also out of the EU, they are actually beginning to allow fully vaccinated tourists without a quarantine. So if you are fully vaccinated, I guess apart from certain types of vaccination, you can actually come into EU without being quarantined. So the good thing is developed countries are reopening up. Next slide. Okay, this one, I think we should keep showing this, but I guess the one takeaway here is Malaysia. So the Malaysia, the one on the left on the yellow line, you don't see it here because it's only moving average, but the latest cases are about 6,000 plus. So this is a big surge. Their peak in the past didn't even cross 5,000. So now they're hitting 6,000 and more. So that is the one that's the big wave is happening now in Malaysia. The rest is tend to be dropping. The one on the right is quite self-explanatory. I think in Europe, cases continue to dwindle down. Next slide. I think Singapore, we all know what's happening, so I won't comment so much, but you can see the chart in red, the red line, the 7-day moving average. You can see the big spike. If you want to measure, I didn't really track the unlinked cases, but in terms of the community case, like we mentioned before, during circuit breaker was about 50 a day. Right now, we're hitting about 26, just to give some context of how far we are right now. And next slide. Okay, I'll just go through two stocks. Again, the reason why we do Phillip on the ground is I know a lot of people may not get access to these meetings. So we just want to share with you what were some of the key points we think that transpired in the meeting, so that at least everyone can get updated if you know on some of these stocks. So for Geo Energy, they did a first quarter results briefing. So Geo Energy is a coal producer with their mines in Indonesia. So their profit did very well. I think first quarter they made like a huge, like almost 30 million US from a loss last year. And also, and then if you kind of take this the 29 million profit, and then you kind of analyze it, the stock is trading, I think, like 2 times PE. I mean, even if the numbers are wrong, get it 3 times PE. And also the other positive for this stock is that they swung from an 88 million net debt to 20 million cash. I'll explain later why. So not only are they trading 2 times PE, they are back into a net cash position. Of course, what has helped is ASP is up 17. Their customers are mainly China, Indonesia, and they use all these all these traders like Trafigura to sell for them. The one amazing thing was that they actually saved 24 million a year US dollar. This is incredible. I mean, you can save interest 24 million. So what they did was, because their senior bonds dropped from 300 to 59. So what they did was, since December, especially last year, they actually bought back a lot of the bonds. So they actually issued bonds in 2019, 300 million. Then they bought back 240 million, and they made like 100 million US dollars from this. So obviously the bond guys are the ones, the senior note, those who held the senior notes are the ones who lost, because they bought it below par. I'm guessing maybe 40, 50 cents, I presume. And then that's how they managed to make this big one-off gain of 106 million and save 24 million. Okay, the other thing is just that the cash cost is down, and because of the strip ratio. I think I won't bore you that, it's a bit too technical. In terms of the outlook, I think the second quarter could even be stronger, because what has happened is that the coal price was 56 in the second quarter. That means this quarter. But last quarter, when the results announced, was 42. So you can expect another good set of numbers in the second quarter. And the table on the right is just to show you the pickup of imports from China. That is up like 20%. And also, I think the dispute with Australia probably had a factor too. Probably they want to take more coal from Indonesia than Australia, I guess. Next slide. Okay, the other thing is Trang Gloves. So they are a glove maker based out of Thailand, and they just did a dual listing here on the 10th of May. So I'll just give you some highlights, and they will be doing a webinar with us in June. I think 8th of June, I think, or 3rd of June. Yeah, okay. Anyway, this company is huge. This company is like almost 6 billion market cap. The first quarter profits jumped, 22 times. I'm not sure how to calculate, but like 22 times year on year. So they made one quarter a huge, like 450 million Sing in just one quarter. Their capacity is roughly like the size of Kosan, I mean, for those who want to know. Of course, what has helped them is that the selling prices surged threefold. And then mainly nitrile, I think. So they're going to go on a big aggressive expansion. So they're going to raise their capacity 40%, which is like 20 billion gloves in just 1 year. That's their target. But of course, the main thing everyone is focused on is the selling prices. So what they say is that the prices peaked in April, and they started to decline in probably June, about 15-20%, and the decline is still happening even in going to July. So they're still dropping month on month. And one of the reasons, of course, there was a question on why the liquidity low, because they mentioned something about the shares not being fully transferred yet. But anyway, the rest I won't go through, but just want to explain a bit the table on the right. So we just did a rough estimate on the net supply coming on and the net. This is a net increase. So what you see is that in the past, the blue line, the demand for gloves tend to be maybe 30 billion or so a year, roughly, net increase roughly. Then this in 2020 and 2021, it spiked up to almost 60 billion. So that's why there was a big mismatch between the red bar, which is supply, and the blue bar. So demand just exceeded whatever supply they came on stream. But of course, the worry now is we go into 2022. Again, these are all estimates because forecasting supply coming out of China is next to impossible, because not really sure how much comes up, but we just do a rough estimate of 15% of total supply. So what you can see is that there's going to be a big jump in supply in 2022. So I think like Sri Trang is 20 billion addition. Then I think Top Glove is also going to add 20 billion. So that's 40 billion. So that's huge, considering the increase is roughly about 60 billion. So if you assume 2022 is 60 billion net increase, supply is going to be, there's going to be a huge jump in supply. So the worry will be more the later quarters of 2022, because there's going to be a lot of supply coming in. Again, these are just estimates. And also the purpose of the green line is also quite important. So what has happened is that right now margins are about 60%. But as you can see, the historical margins about 20%. And what we worry is that all these producers will keep on producing, raising capacity until maybe their margins drop back down to the historical 20+%, because even at these levels, they were raising capacity. So even at Sri Trang, they mentioned that even if prices drop by half, they would still increase capacity. So that is the worry right now. I mean, as we move forward, there will be a huge amount of capacity increase. Yeah, okay, anyway, I know, sorry, this is a bit long at the presentation, but this is my last slide. I think we can move on to questions if there's any. Thank you everybody for listening in.
Hi, so I'll take the first question. I'll read out the question first. Okay. The NAV figures from your previous valuation for the development properties, investment properties are direct read off the balance sheet. How about the fund management's NAV? So this question is actually about CapitaLand. And I'm guessing that the NAV you're referring to is the one from page 4 of the report, which is the RNAV table. So with respect to the development properties as well as the investment properties, these are actually not the balance sheet figures. So the RNAV stands for residual net asset value, and what it actually means is that we take the stake of the NAV that belongs to CapitaLand, and then we actually value it based on, or rather we project a growth rate or the next financial year's NAV for the assets that are attributable to CapitaLand. So the short answer is that no, this is not actually taken from the balance sheet itself. As for the fund management, so the fund management platform, it comprises we evaluate using the PE multiple. So the PE multiple is from the fee income that is generated from the management of the REITs as well as the private funds, etc. And we assign a multiple of 15 times to the PATMI. Yeah. So that actually derives the fund management valuation. Yeah, as well as for Escort, is also using the PE method, and at 15 times. 15 times. Yeah. Okay, that's all for me.
Can we go on to now answer? Can I turn on the video? And also, Jeffrey, I think can you just stick on some of the Yoma? There was something on going to the right slides. Can someone put us to the, sorry, which slide is it?
Yeah, okay. Hi, I think there are a couple of questions for Yoma. First, I think what is the cash burn rate of Yoma after the coup, and on average, how many million losses per month? Okay, for this question, I think the burn rate is typically calculated in terms of the amount of cash or OPEX the company is spending per month. So in terms of the OPEX incurred each month, it's typically their admin, finance and tax expenses, which is about 40 million on a 6-month basis. Then if you calculate, it'll be about 7 million per month. This is actually quite similar to pre-COVID levels where I think as in like despite actually possible price increases in construction F&B, which they might have taken on during this period of time. We're actually expecting this burn rate to reduce also, as mentioned earlier. So you might actually cut OPEX and deferred most of the CAPEX to conserve cash. They slashed their staff costs by more than 60% through extreme pay cut through extreme pay cut. I think their CEO, their chairman, and CFO actually forgo their salary completely, and then also the inventory has been reduced. On on top of that, they are also we are also expecting lower interest rates, lower interest rates to actually have to benefit Yoma in terms of their finance expenses. And then as more stringent financial management has been implemented since the start of the coup, we should be able to see better cost efficiency gains in the coming months. Yeah, I think the next question we have for Yoma is in the chat group. So why is Yoma halting their involvement with Ant? I think previously mentioned, Ant was actually enthusiastic about the Wave Money deal. And even though the Wave Money deal wasn't officially closed then, Ant actually acted as a shareholder for the past year or so, and was actively participating in board meetings. So the main reason why the halt was the main reason for the halt is actually because there were delays or lack of headway in the approval process after already extending the long stop date, I think twice. Therefore, I think all the parties actually mutually agreed not to extend this further and let things settle, given that the timing was a bit off and it's likely that they won't be able to make much headway even in the next half a year. Yeah. So this is all for Yoma.
Terence, you want to help out on the Koufu questions if you're able to? And also the next one will be Maple Tree Industrial REIT. Natalie, if you can, thanks.
Yeah, okay. So I'll take the Koufu question first. Sorry, let me just go to the question. Yeah, so I'll just read out the question. Koufu financials show deterioration in relation to its industry comparisons. Example, Kim Lee, who reported positive financials first half 2021 on 10 May 2021. Could you comment on this disparity? Yeah, so thanks for the question. For when we compare Koufu and Kim Lee, you're right, that there's a disparity in terms of their results. And this is really two main reasons why there's a disparity between Koufu and Kim Lee's results. First is first is their operations in Singapore. So in Singapore, for Kim Lee, their outlets are mainly located in most of the industrial and canteen areas in Singapore. So those areas tend to be a little bit more resilient. They do see reduced footfalls, but in those areas, industrial estates, they tend to be, because most of them some of them cannot work from home. So the demand is also more resilient in those places. Whereas Koufu's outlet concentrations, they have in the heartland malls. Of course, sorry, I just take a step back. They have operations all around Singapore, but Koufu's outlets are concentrated in the downtown areas, the city areas, and also in some of the educational institutions which are hardest hit right now, such as SMU, Singapore Management University rather. So because of that, they get impacted more from the work from home arrangements that have been imposed on their operations. And then also other than that, also Koufu, they have for some of you who follow this company, you all know they be impacted even more negatively by the lockdown in the clampdown in the travel into Singapore, because they have the Makan Sutra food outlet at Marina Bay Sands, which is also very, very hard hit. So that's the first reason, the geographical location of their outlets in Singapore. The second reason is that when you compare Koufu and Kim Lee, Koufu has operations in Macau versus Kim Lee. So Kim Lee is pure Singapore operations. So when Macau went into full lockdown last year, and also at the earlier part of this year, the operations for Koufu was very negatively affected, especially in the Macau space, because they essentially closed down new entries into Macau. Of course, we've seen it improve because they started opening up in March and April. But for the first quarter of 2021, because of the stop in inflow of tourism into Macau, the operations in Macau was essentially shut down. So that's why they are more affected. So when we compare Kimlee is then more resilient during this period versus Koufu. Yeah, so that's all from me. If I didn't answer your question, let me know. I'll answer also. So I think that's all from me. Thanks.
Sorry, I'll take the question on Mapletree. Okay, I'll just read out the question. Mapletree's recent new acquisition of the US data center portfolio with a preferential offering to existing shareholders at a price of $2.65. Actually, I just want to clarify, it's 5 new units for every 100 units offered, not 5-to-1 ratio. Yeah, so whether is this really a good offer to take? So just want to point out some things. First of all, of course, the Mapletree intends to raise 800 million by way of equity fundraising, 50 million from the private placement, as well as another 30 million from the preferential offering to existing shareholders. So this actually translates to 45% loan to value ratio. Or rather funding for this acquisition. Based on their pro forma, they actually used the pro forma assumption is a 3.3% DPU accretion, but that is on the basis of a 60% debt funded acquisition. Okay, so I think overall they are actually using, if they were to raise only 800 million in equity, that means that the LTV will be lower at 45%, and that also will actually lead to hold on. That will actually the LTV will be 55%. Yeah, so it's roughly in line with their DPU accretion that they have provided. So we don't have coverage of Mapletree Industrial. So I wouldn't really want to comment whether or not it would be a good offer to take up. Yeah. Thanks.
Is the offer dilutive? I mean, just what's the offer compared to the current price? Is there like is it very dilutive? So I didn't really.
I believe that for the preferential offering, the discount to the current VWAP is about 6%, if I'm not wrong. Yeah, let me just pull it up again.
Well, is there some theoretical rights price? I mean, theoretical placement. Oh, okay. Yeah.
Let me check on that again.
Yeah, okay. But anyway, someone just asked, should take or not. But I guess the general rule is that if you look at the theoretical, if it's a rights, if it's not very dilutive, then I think there's no point taking it. I mean, then what's the purpose? Unless you want to double down on the stock. But if you have no plans to do it, then no real purpose. But of course, if it's dilutive, then it's worth taking that up. I mean, that's a general rule. Because I see this question addressed to me. There's another question. Let me just try before we move on to the technicals. What is ASP? I know it sounds like a simple question, but it's also a good question to ask. So ASP is average selling price, and the question asks, why not just put selling price and then make everyone's life so difficult? But the reason why we put ASP in, why in all the slides by the companies they normally put ASP is because it's supposed to be the average. So sometimes you talk to these companies, then they will tell you, oh, this is my selling price. Then they will always tell you their higher price or lower price, whichever benefits them. So that's why the industry just want to get the average. So at least we get a blended price. No, because you tell me what's your selling price, then they normally tell you the highest price they ever sold. So this is just one way to get a better reflection of the selling price. So that's why we kind of make life difficult for everyone and put it as ASP. The next question is, hi Paul, for Sri Trang, what do you mean by low liquidity as share price are not completely transferred? Okay, what happened was that I didn't ask the question, but there was a question asked why the liquidity for Sri Trang was almost non-existent. Okay, and the reason they gave was that there was supposed to be a block of shares transferred from Thailand into SGX, but there was some delay and so far. I'm not sure the technicalities of how much was to be transferred. I didn't read the circular, but that was one of the reasons. There was a block of shares from Thailand supposed to transfer, but there was just some delay to it. So I hope that helps. Maybe in our webinar with them, I can get more clarity. But thanks for the question. I think we can go on to the technicals of Viren if it's okay for you.
Yeah, so if possible, could all of you like just raise up your hand to say you can see my chart and stuff like this, and hear me loud and clear just before we move on. Thanks. Okay, thank you everyone. So I looked through a Q&A. So due to time constraint, I think I won't be able to answer all. So I just picked the most popular ones that's been voted, ranking from top to bottom. All right, so you can look at ST Engineering. I think that's the first few questions. ST Engineering is still being rejected at the resistance zone, and then after that there's a sell down. So if you look closer, right, this range between $3.65 to $4.10 is likely to file a lower support at this level between 3.54 to 3.40, which is the extension level of A, B, and C. So lowest level, I think we won't be seeing $3.40 being rebounded. So we will be seeing $3.40 maximum level to uphold. And should this be broken, then we can see a renewed downtrend to continue some more. Okay, so if you look at the weekly chart, prices are still well within like a tight range. With price, if you zoom out, with price trading in a very tight range. Hence, there's still a lot of rooms for fall in the future. All right, but we're going to return back to the daily chart. I think short to mid-term wise, I think we can look for support between this level, which I mentioned earlier on. Okay. So move on to the next one is Jaffa. So Jaffa still maintaining a bullish outlook despite prices fail to close above the 50-day moving average over here, but price is still within the support zone 1, rebounded last week, and then well within a bullish flat. So hence, potentially wise, I think Jaffa still have a potential of further upside if you see. All right, basically, I think the resistance zones is still tough. So price is still well supported, like what I mentioned earlier. So hence, bullish upside for Jaffa is still ongoing. Okay. So I got a new stock that is out on today. So it's Tianjin. I don't know, it's T14. So if you look at that, we have already completed inverted head and shoulder. Prices has broken out successfully with a higher high and a higher low after breaking out of the falling wedge. The inverted head and shoulder is still well supported. Just that this resistance zone is still pending to be broken out. So hence, we are seeing some sort of we are seeing a very strong possibility of a continued upside. However, I think if you look closely in the daily chart, prices still struggle to stay afloat. There's a bearish candle today. So hence, if this candle is well supported, okay, prices is likely to form another upside like this to break the resistance zone mentioned earlier on. Okay. Okay, the next one will be SunPower. SunPower wise, we are still seeing a fifth wave yet to be completed. $1 is still not psychological resistance that we are facing on. So hence, if you look at that, we have a true wave pattern. Most likely is going to be a panel. Okay, a potential panel or expander flat, or running flat. Sorry. So hence, this any upside, you will still be kept at the resistance zone and then come down and then looking for a key support zone 1 or zone 2. maximum will be key support zone 3 in the longer term before a rebound to the upside. Overall, if you look at the chart, I think we are still on the upside. Bullish crossover, we are still here. But what I'm worried is this candle, if it is a weak bullish candle, that this might be an island reversal, immediate island reversal. So you'll feel to get rebound and then hit lower down to the key support zone. Okay, so that's my outlook for some power, neutral for now. Okay, so the next one is Coke Cement. Yeah. Okay, so price is still on the downtrend. You look at the weekly chart. Price has already been broken out of the ascending channel. And price is like hovering down here. So we are in a very tight range over here. So, but any bullish candle we will see limited upside because I think $48.90 to $49.70 is likely to be a tough resistance zone. Okay, so if price is going to rebound, then if price is going to break the resistance zone 1, I think resistance zone 2 between $51 to $52.20 will be rejected. All right, so hence just take note that this will be a tight range. So, and if the resistance zone 2 is it has appeared to be a strong selling, then we will see price reversing downwards very strongly. Okay. Okay, Hong Kong Exchange. Recently, I think last month I released a report based on the inverted head and shoulder. Price has a false breakout, didn't close above the resistance zone at $500 Hong Kong dollars, and it has been making a wave down going on. Okay, so hence and then price has faced some rejection at a 50-day moving average. So hence I think price is going to find its support over at this level between $381 to $400 before a rebound. We can expect like this to be a larger true wave pattern, 2 and 3 before a rebound. Okay, and if there's extended third leg of wave C, then we can see that 302 to 322 will be the next rebound zone as well. Okay. So next one, Raffles Medical. So Raffles Medical upside has been broken. Series of higher high, higher low has been observed, but price is yet to break the resistance zone. Hence a slight pullback as long as prices remain supported at this level between 0.98 to 1.02. We can see that price is likely to retest the resistance at 1.20 to 1.21. All right, so do look out for this level. Likely it's going to break to the upside to go to $1.39 in the midterm. All right. Okay, so next one is Maple Tree Industrial Trust. Maple Tree Industrial Trust, after a deep sell down, breakout of the mini double top, price has completed fulfilled the two the 1:1 ratio of the double top. So hence, any upside, this resistance zone, immediate resistance zone at $2.80 to $2.84 is likely to be be broken up on the upside, and then price is going to target $3 as the next target for Maple Tree Industrial Trust. All right. Okay, so AEM, I think someone asked about AEM. AEM still very corrective, so hence I will stay out of it. Despite there's a bullish candle on the upside, but this momentum seems to be corrective. The larger in response to a larger impulse downside wave, so it could be a 3-wave up, and then before coming down and rebounded at $2.88 to $3.05. Okay. So for next one, Escort Residential Trust, it has a double top. So right now it is testing the crucial neckline resistance at 0.975. Any upside is going to be limited, and then price is going to break down and retest and break the ascending triangle uptrend up the upslope, and then test the next support zone at 0.860 to 0.900. So hence, I think Escort is going to face further correction in this retrospect. Sheng Siong is performing relatively well after a rebound last, I think, 2 weeks ago. Price managed to form above the to close above the 200-day moving average. Should this candle appear remains a strong bull shaven top, then we'll see a further upside. Because in the lower time frame, you can see that it is forming like a corrective pattern. Okay, so Sheng Siong, I'm quite bullish. Likely price target is between $1.80 to $1.83. All right, for Singtel wise is a tight range. Price rejected the resistance zone. Have had a deep correction. So price, the next immediate resistance has been lowered to 249 to 252 this region. Breaking it, we'll see the next target at 264 to 269. All right. Just take note that that there is also an inverted head and shoulder forming. Hence, I think over the long run, Singtel is going to reverse to the upside, test 3.24 to 3.35 in the next foreseeable future. All right. QMM Dental, you look at the weekly chart, also inverted head and shoulder has been broken. Price has really on the upside. So theoretically we can confirm that QM Dental has revert to the upside with a series higher high, higher low, and higher high. Just that this is a bit tricky. 0.735 need to be broken to confirm further upside. Should 0.735 be broken, I think the next target at 0.815 will be the next target. So what can we expect from the daily chart is that he has already broken 0.685 resistance turn support level. Okay, so if price is going to stay sustained above this level by around 4%, which is price going to close have a bullish closure at 0.720, then likely we are going to see 0.735 being broken, and then like what I mentioned, the weekly chart, we will see further upside for QMM Dental. Straight trading weekly chart, we are seeing a potential bullish golden cross after it has broken out of the falling wedge. Hence, this is like a stronger upside already. Daily chart shows that price stays well supported above $2.50. But the tricky part is price is still within the below the 50-day moving average. Hence, I will look at lower buying at $2.60 before rebound. All right, this candle, this pattern, this like a wedge pattern is still is like has been broken. So hence, we will look at the is rebounded at 1.236. Likely to buy at I retract my word. I'm likely to buy at $2.41 over the longer term. Thai Bev, I issue a report. Price rebounded, but price having some sort of consolidation over here. The tricky part is 0.71 to 0.715 need to be broken to confirm the upside. But I think that there is high chance because first of all, the bullish flag is ongoing. Otherwise, I think price is going to, if price is going to fail, I think we're going to look at 0.635 to 0.650 for next potential sub leg down for rebound thereafter. Okay. So for Genting wise, Genting has an impulse bearish wave now. It's like if you count in the LA wave 1, 2, and then we have a long extended wave 3. Wave 5, I think rebound will be, we're looking at beyond the 0.680. So hence we are looking on the upside for that. Okay. Over at 0.690. So likely this ascending channel is going to be broken. So any upside will face tough resistance at 0.840 to 0.855. So something like this. Okay. So lastly, I think OCBC target price beyond $13 is my first target price, then followed by $14.10 on that. So price is going likely to fill the gap before slight retracement before resuming on the upside. I think the bank's technical is showing a very strong bullish upside, as you can see from the larger weekly chart as well. Price already has some sort of like broken out of $12.17 resistance level. Okay. Then for Capital Corp, I think we'll face some consolidation, like what I mentioned last week, A, B, C, D, E, 5-wave triangle before rebound back, broke up the immediate resistance at 5.76, and then we're going to see price at 6.12 to 6.14 as the long-term target price. All right. Someone asked about Hang Seng Tech. So Hang Seng Tech, this is like based on, okay, so today it has a sell down. So Hang Seng Tech, you can consider buying, all right, because first I think there is like some sort of consolidation over here, but I will suggest buying at the lower price at 7,581 region. Okay. Then Capital DC rate rebounded, price reach have a slight breach through above the resistance 2.66 before a correction. So longer term, I think I'm seeing price target at 2.88 for Capital DC rate. So for more information, you may read my technical pulse at stocks BNB. I think it's still valid for now. Okay. Then lastly, I think Fortress Minerals. Someone asked, Fortress Minerals still within this double bottom at 0.655. But however, I think that the main bulk of the strong support is 0.525 to 6.05 after, I think, last week of April, it forms like a Hikake pattern, and then it breaks up, bullish Hikake, then breaks up, and then continue on the upside. But you look on the wave perspective, we are on a extended third wave, and then chances are we are looking for a tight range for now. So it will be something like this, and this, something like this, okay, for now. But looking at the iron ore prices, price has also come down, so we are likely to see a long-term support of the iron ore prices over here. So you may use the iron ore futures as a guideline for Fortress and Southern Alliance as the technical chart. All right, so I think that's conclude my technicals. So I'll pass my time back to my colleagues for other further questions. Thank you.
Okay, thanks, Viren. I think we can. There's some banking questions that Terence, are you able to? As we wait for Terence, just a quick question. Try to answer this on Trang chart. Where is the source of the info for supply and demand? I heard that they are doing a dual listing for gloves in Singapore. What's the impact you reckon? For the demand and supply chart that we did, for demand, we take it from MAGMA, is the Malaysian Rubber Glove Association. So demand, we take it from there. For supply, we virtually have to compile it our own. So we just take all the listed manufacturers. Then we assume what is their usual market share compared to the world supply. And then we actually, to their market share, then we actually tag on the China, and then we just include, because if China is about 10%, so we just assume China's market share remains the same. Because, you know, as you mentioned, there's no real clarity on the Chinese capacity increase. I mean, you can get one or two listed companies, but the total industry are not clear. So for those in Malaysia, it's a bit clearer. So this is just a rough estimate. Obviously, it won't be the most precise. The dual listing really no impact, I think. Yeah. I hope that answers it. I think we move on to the other questions. Thanks.
Yeah, sure, Paul. So I think the questions on the banks, I'll just read out the question also. With local banks' higher profit for 2021, are we going to see higher dividends versus 2020 when MAS asked banks to cap their dividends? So there's two questions. And then what should MAS ask banks to reduce dividends to shareholders? Sorry, I don't really understand the second question. So if you can maybe clarify what the second question is, then I'll answer. But I'll answer the first one first. So for sure we expected the moment MAS asks the banks to leave the dividends, the banks have already guided that they will resume higher dividends. So that is certain. I think what is not certain is when they will do it. So internally when we look at it, we think there are a few possible dates that they will do it, because right now the only DBS is issuing quarterly dividends. So MAS will have to make a decision on whether to leave the dividend cap before the issuance of the dividend. So the June is one period that they can possibly leave the dividend cap, because DBS will announce the quarterly dividend in July. But we think that is not likely because of the current situation. So the monetary authority is likely to remain a little bit cautious at this moment. So that leaves us to possibly September before the, again, this is our that's speculation. Nobody knows when MAS will leave the dividend cap. But if they have to make a decision, they could make in September. Then DBS can then announce the higher quarterly dividend. Should MAS leave the dividend cap? Yeah, but as to when, really nobody can answer. And the banks themselves, the update based on the first quarter 2021 results is they haven't initiated any contact. Yeah, so let me know if I answer your question. The second question, can you maybe clarify? Yeah, thanks. I'll go on to the next question. How do you read the very recent share sell down by DBS CEO in the light of ongoing COVID impact and potential property cooling measures? So the DBS CEO recently sold some shares, but it is not very, very significant. That's just a few $1 million. So I think it's very difficult to read why he's selling, and it could be also that's just selling periodically. So there's not too much to read as to whether he's timing it because of certain things. I think that's very open to interpretation. So we got no view on this. Yeah. What's your view on OCBC? For OCBC, we currently have a buy rating on OCBC. And our target price is about $14.63. So the way we see OCBC is we believe that the net interest for income for this year will likely be mid-single digit growth only. But the non-interest income is the one that will give them the biggest uplift. I think we're expecting a double-digit growth, about 22% growth in the net interest income. So we expect the revenue to have an uplift for OCBC for this year, overall revenue. And also we expect some reversions in the credit costs for FY 2021 as well. If you look at their first quarter 2021 results, they only made 1 basis point of general provision for first quarter 2021. So that's really very, very, very little. Actually, when you see, they just make 1 basis point. So it's really a signaling effect for what OCBC do to really signal that they've already done enough provisions for 2021 is sufficient. The reserves build up is now even higher than the MAS threshold. So it's sufficient for them really. So this year we're really expecting a double-digit rebound in their overall profit. So the core for us for OCBC is a buy. We maintain that. Now let me just see if there's any more questions for me. Okay, so that's all. So if I didn't answer your question, just feel free to clarify that. Yeah, thanks.
Hi. Okay, I'll take some questions. We have a follow-up question on the CapitaLand valuation. So the question is, the listed non-listed entities is from the market value of the REITs and private funds. Okay, so earlier I said that RNAV stands for residual NAV, but actually it stands for revalued NAV. So at the end of the day, the purpose of valuation is to find the intrinsic value of the share, or rather, and to compare it with the market value to see whether there is a, there is an opportunity for profit here. So for the valuation of the REITs is not the market value, but rather it is the target price of the REITs. So for the cases where we have coverage on the REITs, like Ascendas Ascendas Ascott Residence Trust and CICT, then we use our own house target price. Otherwise, we use the consensus. So as mentioned, the target price is supposed to be the intrinsic value of the REIT. So therefore, when we input this number into the RNAV, then that's the value that we should, the value of the stake that belongs to CapitaLand. Yeah. Okay. So that question is done. Just circling back to the question on Mapletree Industrial Trust's preferential offering. So the preferential offering price has been fixed at $2.64. And compared to the TERP of $2.75, the preferential offering represents a 4% discount to the TERP. Okay, that's all for me. Thank you.
Okay, we just take a couple more before we end it at 12:45. There's one question on Wilmar. No, I don't cover Wilmar, and it's kind of complex company to kind of get the details on. But I think one of the challenges in the near term for Wilmar has been the soya bean crushing. I think we highlighted this before. In the briefing, they just mentioned that there's been a switch from soya bean to other grains to feed the swine. Because in China, they consume a lot of pork, so they're changing a bit of the feed. So Wilmar has soya bean crushing facility, huge soya bean crushing presence there. So the margins there will get hurt, I think, because they're not going to buy more. They're not going to use more soya bean. They're going to use more grains. I think I highlighted that before. So that is one of the short-term overhang. But Wilmar still has some good parts of the business, namely the consumer. So just that you got to get through this. So the upcoming quarter, there could be some pressure on the crushing margins. Again, not totally clear because Wilmar is very complex. So many moving parts. Then you got palm oil, and palm oil refinery. So that's why that's what I can understand right now. That what is the reason maybe of the price weakness? I hope this helps. I know not totally a good answer, but just as much as I kind of know at this point in time. Okay, is there any more? Timothy, can you go ahead?
Yep. Yeah, so for the question by Chan Ho Liang, for SIA MCB, it's not equity and not debt. Why is it on the balance sheet? Okay, that's an error on my part. So it's actually equity. It's just not shares. So it will be equity on the balance sheet. Yeah. So in that case, it still brings down the debt to equity ratio, and it will not, because it doesn't raise the number of shares of SIA at this moment. So it doesn't affect the book value, and it doesn't affect the EPS, so the earnings per share also. It doesn't affect the book value per share also. Yeah, thanks for the question.
Yeah, okay. Let me just help this. So actually we did ask SIA, so what is this thing? It's not equity. It is equity. So if you look at the balance sheet of SIA, you'll see this is equity. But the good thing about this is it's like an incredible invention. But it's like it's not considered when you calculate book value per share, you calculate earnings. They don't count this, I don't know, 8 billion plus. So that's why your book value stays very high because they don't count this. And then we ask them, why don't you convert this to shares? They said because it's not converted. So it's like the most incredible thing. If you ever want to issue any any instrument. This is going to be the instrument to issue for any corporates, because it's not debt, neither is it dilutive equity. So it's like the heavenly product, we call it. Yeah, instrument. Yeah. So I hope that helps. I know there's a lot of confusion, and I think for the TRs involved, SIA is going to organize an event with the TRs. Sorry, it's not open to the public. Apologize for that. But if you want, you can ask your trading rep to attend, because SIA will hold one session with all the trading reps to kind of explain about the MCBs and so forth. Yeah, I think I'm not sure the exact date, but anyway, we will send a circular to the trading reps to register. Thanks. So I think it's kind of hit at 12:45. I'm very sorry we didn't answer all the questions. But again, you can just go to our website. And for those who want to register for this weekly event, because it's recorded on YouTube also, so you can just go to our Powens web page and register there. And for the questions, just go to stocks B and B. So thank you, everybody. Thanks very much for all your questions. You can send in any questions as basic as possible. It's also good for us. So thank you, everybody, for your participation, and we hope to see you next week. And thanks again. Take care, everybody. Bye.